But as I look around, not every covered call fund is doing this. So can you explain how you're returning capital to the investors when you're actually not returning their capital?
Then we have the ability to outperform the S&P.
Some YouTube channels do sponsored videos where a fund will pay a YouTuber money to talk about their fund and basically promote it.
We have actually already changed that. I think that's great feedback question. So
I posted a review of SPYI back in June of 2023, and it was somewhat negative. And that's because the research that I did uncovered a few concerns that we're going to address head on today, because we have Garrett Paolella joining us, and he is the co-founder and managing partner of the SPYI fund manager, NEOS. Welcome, Garrett.
Thank you. I appreciate being here today. Thank you for the opportunity.
So before we address those concerns, if you could just give us a brief overview of SPYI's objectives and strategy.
Sure, I'd be happy to. So the NEOS S&P 500 High Income ETF, SPYI, it is seeking to provide a high level of monthly current income in a tax-efficient manner. The way that product is done is by fully replicating the S&P 500. So we have a partnership and a licensing agreement with S&P. We fully replicate all S&P 500 equities. And on a monthly basis, we institute a laddered covered call strategy, which is really focusing on selling out of the money S&P 500 index options that provide you with a target income on a monthly basis of around 1 to 1.5%.
Okay.
Those options are positioned traditionally between 1 to 4% away from where the current market is, meaning 1 to 4% out of the money.
Right.
And that allows the investment objective of current income and tax-efficient income first, followed by the ability to capture upside in the equity moves, because we want to make sure that there is a fulsome total return to the underlying fund to generate the income, and then secondarily the growth in the upside capture.
So just to clarify a distinction there are funds that, like XYLD, that sell at the money calls, and you just described that your fund's different in that you're selling out of the money in the range of 1 to 4%.
That is correct. There are a couple other factors to it that we're also not looking to write on the entire portfolio. So we want to leave a portion of it with the ability to also appreciate completely with the moves in the S&P on the upward side. So traditionally, or I would say historically, since the fund's been launched, we've been anywhere between a 75% to a 90% overlay. So you kind of have this 10 to 25% that can appreciate as the market moves higher. So we want to really balance the income generation, but once we kind of hit that income target, we want to allow the fund to be able to appreciate in value. So that's another differentiating factor from some of the other products out there, is that we focus also on being able to allow a portion of the portfolio to not need to be overwritten to hit that income threshold.
Okay, so you've got quite a few levers that you can pull there to take advantage of some opportunities for appreciation. It's not just one or two things.
That's correct.
Most of the distributions for the fund come from selling covered calls, and that's a function of the volatility of the S&P 500 index. And that volatility is constantly changing all the time. But as I look at the distributions for SPYI versus other funds, the SPYI distributions look less variable. So is there some reason why they're so consistent?
Sure. So we do target for this fund that the distributions could be between 10 to 12%. They historically have been 12% for the trailing 12 months of the product. But what is a part of the investment process and a factor within looking at volatility is where we're setting those call options. And so in a lower volatility regime, we might be closer to that 1% out of the money on the various calls that we're writing. At a higher vol environment, we could be further out. So we are shifting the percentage of the out of the moneyness of the calls in order to generate that income, and then also the percentage of the overlay. So as we saw more recently with volatility coming in these last few months, that has been a traditionally slightly closer selling of the call options and a little bit more of an overlay on the fund in order to meet the income threshold.
Changing subjects slightly, I mentioned back in the June video that you and one of your colleagues, Troy, were also working for a competitor, Harvest Volatility Management. And I checked more recently, that's no longer the case, but is there anything you can tell us about that?
It was just a natural move. We had worked with Harvest for a number of years. They were an option-based manager. We focused on ETFs within the organization. And previously, before Harvest, Troy and I have established a couple of other asset managers focusing on this very same space of option-based ETFs. And we wanted to get back to having, our firm and bringing more solutions out into the marketplace. So we established NEOS, and it was just a natural transition to leave Harvest and be, fully here at NEOS.
You have a history of working with options, but prior to NEOS, you were part of other firms. And now this is your baby, so to speak, yourself and Troy.
That's correct. So Troy and I did work together at another firm, and then we founded back in 2013 one of our first asset managers. We ran that for a number of years, issuing some of the very first option-based ETFs in the marketplace that are still in existence today with significant assets. We subsequently had a sale of that firm to another organization, which we joined and worked at for a number of years. And then we transitioned out of there as they were heading in a different direction than where we were focusing on these option-based ETFs. This is our core. This is what excites us, using options as ways to, enhance yield, to mitigate risk. And so when that firm went a slightly different direction, we continued in our very core focus that we liked. And that's how we ultimately joined Harvest. And we wanted to continue to bring more innovative solutions in the ETF market with options. So we established our own firm again, NEOS, and have now been issuing, our products for the last, 1+ years.
I should mention that some YouTube channels do sponsored videos where a fund will pay a YouTuber money to talk about their fund and basically promote it. This is not one of those channels or videos. So you can just confirm you're not sending me any money or Starbucks gift cards or anything.
Yes, that is correct. This is just a content informational only interview.
No use of the corporate jet, the Vail ski lodge, nothing, right?
Yeah. Well, we have none of those, but no, you are correct.
Oh, I see.
There are no perks besides two guys liking to talk about option-based income strategies.
Good. All right. So in addition to selling covered calls, part of your strategy is that you also buy calls. Is that correct?
That is correct.
How much does this move the needle? Is this a really key part of the strategy that boosts returns significantly, or is it something you just do occasionally?
So it's something that comes out more occasionally. When we actually buy a long call, the model has not yet indicated for us to do that, right? So we have not bought any long calls since the fund has been, live. When this might happen is in a very low volatility regime where we might see when the VIX was sub 10, right? If we get back into that type of environment again, in order to generate the income, we might come less than 1% out of the money, right? It might be closer to like an at the money or just slightly away from where the current market is. And so those environments, when you get a very slow grind higher in equities with a very low volatility, again, we did have a lot of stimulus here in the U.S. from the Federal Reserve happening at that time. But if that were to happen, that's when the model would indicate for us to take a portion of the income generated from that written call to buy an out of the money call. And the real crux behind that is you get convexity in the options. So if the market starts to move higher and that long call's in the money, you get to have a really nice upside return from the fund to really protect that kind of growth in a low vol grind higher market. And so that's when we would see the ability for the model to buy a long call. That does make us much more unique. No other product in the marketplace today that we're aware of, has a function of buying long calls as well. And really, as we think about that, is twofold. It's one, protecting the upside in almost a risk mitigated way, but being able to add to the total return of the fund, because that's an important element of the product, is to always think about the income that you can generate and distribute to investors. But it is about, making sure that there is a fulsome total return there, because this is a more equity allocation.
Right. Okay. So you mentioned the VIX at 10. That's not something that happens often. So this is something you would deploy occasionally. And then when you do deploy it, it's different from selling covered calls. I mean, you buy the long call. If the market goes the way you think it will, there's plenty of upside there in that call. If the market doesn't go the way you think, the call expires and you lose that money. Is that correct?
That's correct. So this is it's called a call spread. And so we sell a call that might be, let's say, at the money, and then we might buy a call that's 2 or 3% out of the money. So what that's going to do is still leave you with a net credit. So still income coming in off the sale of the written call, but you are taking a portion of that income to buy the upside. And so as you said, if the market sells off, the amount you paid for that long call, you would lose that. And you would only make the money that you had from the written call and the spread between, those two. So it's a call spread as opposed to just buying long calls. We'll still have the income being generated from the sold call.
And as you mentioned at the beginning, it's not, I think you said you haven't deployed that strategy yet, but it may happen in the future.
That's correct. It's part of the model that helps us run the product today, but we have not gotten to those types of volatility levels over the last, little over a year to have any long calls be purchased.
All right. Well, that addresses my concerns about that. And also, it's not something we need to really focus on because it doesn't seem like it's moving the needle on a day-to-day, week-to-week, month-to-month basis anyway.
That's correct.
So let's get on to a really hot topic, return of capital. This is something I raised in the first video, and then the next day I put out another video explaining that return of capital can be destructive, but also can be a tax treatment. And for SPYI, it's become clear in the months after those videos that it's the latter. It's a tax treatment, not destructive. So my question is, if you could explain this tax treatment, how is it that you're able to, people get these notices, they say there's return of capital, these notices, it's a fairly high percentage. If someone's not familiar with return of capital, they may have some questions. So can you explain how you're returning capital to the investors when you're actually not returning their capital?
Yes. So this is a great topic, a conversation we like to engage with. I will say you have to consult your tax advisor. We can give actual tax advice, but we could talk about how the structure of the fund looks to work and what some of this return of capital means. So the term return of capital was much more looked at and known back in like the mid-2000s and 2008 with a lot of closed-end funds that still meeting their distribution percentages, but they weren't actually earning enough money because the fund was in such a loss. So they were returning people's actual capital to them.
And that's where a lot of the confusion, sorry, Garrett, that's where a lot of the confusion is. You've got these CEFs actually returning investors' capital for the reason you just cited. And you've got ETFs like yours, and the phrase is used, but it's a different thing.
That is correct. So what we want to do is we want to have a tax designation of return of capital, but we want to not return individuals' principal investment, right? So it's not a return of principal. When we think about return of capital, what we want to do is from a tax standpoint, we want to find gains and positive returns in the portfolio, but marry those with a historical loss at some point, right? So let's just say the equity markets have been extremely strong and your short calls aren't going to make money for those really strong periods, right? So you're going to have a loss at some point, right? You have a long short portfolio in a cover call strategy. Well, we want to harvest the losses when we can. So depending on what's going on a month-over-month basis in a market cycle, we want to harvest these potential losses so that when you do lose money within the fund, right, you still get a benefit from it. So what's really unique about our tax classification of the fund and just the ETF structure is that you're allowed to carry losses forward indefinitely. So as you think about your actual annual tax filings, right, when you have a loss from something, you get to match that off with a gain and not have to pay taxes. Well, you do the same thing within the fund. That actually designates the tax classification to be called the return of capital because we've been able to pair a historical loss with a gain and meet that for the distribution. So our goal in the product is actually trying to maximize tax efficiencies. And so the two ways we really do that are using index options, which get a 1256 tax treatment, meaning all returns and gains are taxed at 60% long-term and 40% short-term. However, we then try to have the tax loss harvesting element that we get to carry these losses forward to pair them with our monthly distribution. So
Right.
the idea and the concept is total return. And so as you can see, year to date, we distributed probably roughly around 8%, because we're about 8 months through the year. We have not had our September distribution yet. Fund is up well north of that, right? We're up 15, 16%. So we've made 15, 16% within the fund, and we've distributed 8. So there's no destructive return of capital. But what we've been able to do is reclassify the monthly distributions to be that of return of capital. So investors would not pay for the distributions on a tax basis in that current year. It's not tax-free. What ends up doing is it then allows them to reduce their cost basis in the fund. So if and when they sell the fund in the future, they're getting a long-term capital gain. So we're trying to convert everything into the most tax-favorable way for an investor. And so the return capital structure really allows investors to not pay it that current tax year, but reduce their cost basis and defer it to being a long-term capital gains treatment. So it's taxed at the lowest, possible tax rate, with the investment structure.
So you mentioned a few things there that I want to come back to, but before we get off this return of capital thing, we're not going to go through the tax code today, obviously, but if someone wanted to get more detail about this, aside from obviously contacting their accountant, do you know of any either part of the tax code or some document or some location where people can learn more about this, get more details?
Sure. So actually, I think starting as high level as you can, go to Google, search Section 1256 options. Those will explain how index options that we use linked to the S&P 500 have a favorable tax treatment. So I would say that's one of the first things. The second is then actually Google return of capital, and you can Google that with the IRS linked to it. And I would go through and read the first sections to where they explain return of capital and how that is actually taxed, right? And it will explain to you that it is not taxed that current year, but it does reduce your cost basis and basically deferring tax to a longer term. I would suggest those are two things. We are working on some of our own content and material that hopefully in the next couple of weeks, we'll have up and running for investors to be able to review on our side. That gives an overview of, return of capital relative to other, tax categories that other funds have. So we will continue to be producing more and more content to help educate, publicly on this. But I would say those are the two great places to start. Educate yourself, and then you can always certainly talk to your tax advisor, about a more specific, answer to you and your financial situation.
Okay. Yeah, if you add something to your website or you create a document, I will publicize that on my channel. I appreciate that your attorneys would have to go through it. You can't just type out something on Google Docs and throw it up. You need it to be precise and accurate. But I think that would be really valuable because people get these notices, they just see those 3 words, and then they're not, if they're very savvy, they'll understand it. But a lot of people will assume that the capital's actually returned to them, and it's not the case. So definitely good to hear that you're going to make that explanation. So we're not off tax just yet. I saw on your website that there's a Form 8937 that was added to your website. Is that something we need to do anything with? Is that an important thing? What's the reason for that form on your website?
Yep, nope. That's just an additional required disclosure, from compliance and our requirements. It just expresses and explains that this is a portion or a percentage of the distributions or return of capital. And it would be your responsibility to let your tax advisor know that it is reducing your basis. So it's just letting people know that that isn't something that automatically happens out there. It's nothing that us as the manager, are able to do. It's up to you on your side in order to let your tax advisor know that a portion of this has been, deemed a return of capital and would have to reduce the basis.
Okay, so someone could just print out that form that's on your website, the 8937. When it's tax time, hand it to their tax accountant, and then they'll obviously know what to do with it from there. That's all they need to do.
That's correct, at the most. A lot of times it's already handled at your custodian level, but I can't speak for, all clients at every custodian that they do things equally. So ultimately, yes, if you want to be safe, it'd be great to provide the information to your tax advisor, but a lot of it should be included in the majority of the major custodians out there. holding.
Okay. You mentioned before that return of capital has some advantages when it's used as a tax classification, as you're doing with SPYI. You're deferring the payment of the tax, and for most people, the rate on capital gains is lower than the rate on ordinary income. All of that sounds great, is great. But as I look around, not every covered call fund is doing this. I saw Eaton Vance is doing it. I'm talking about return of capital as a tax classification. Global X is doing it. So my question is, why is it more common, and or are there any downsides to it?
Yeah, sure. Our opinion is, it's the preferred method to reduce taxes. We here have a big thesis within any of our investment products that we always want to think about the net after-tax return for an investor. And so we think the most tax-advantaged way to do that is having return of capital. It depends also on the investment or the portfolio manager's methodology. There are products out there that actually like to show that it's ordinary income, because if it's taxed at ordinary income rates, meaning they're using like a synthetic option to get it included as a SEC yield calculation, right? They can promote the yield in a different way for marketing purposes, but it is taxed at ordinary income rate. I don't think that's as favorable, but because that's the portfolio manager's decision, right? There's nothing wrong with it. It's just, it's preference.
Right.
Other managers, yes, are using these same 1256 options, and they're trying to get a return of capital in advance. I think you mentioned, also Global X. I think it comes down to personal preference and also the overall investment strategy within the product. We personally feel return of capital is better, and using index options are the most beneficial for end investors.
Well, that clarifies a lot of information that I didn't see on your website, but as you mentioned, will appear in the future. What is on your website, though, is the two things you mentioned before, which is 1256 contracts and tax loss harvesting. So my question about that is just simply some kind of sense of the scale of savings of those two things. Is that something that's going to save everyone a ton of tax, or is it something that for some people it'll maybe save them 5 or 10%, but it's not significant? Can you give any kind of, I know this is a difficult question, but any kind of sense of ranges of savings that they would give?
Yeah, sure. So when we talk about a 1256 option contract, I'll just explain those index options versus others first quickly. So the index option, as I mentioned, gets any gains or returns regardless of holding period, right? A day, 20 days, 50 days, 60, 90 days, 360 days. It is taxed at 60% long-term capital gains rate and 40% short-term, which ultimately means basically ordinary income on the 40%. So that 60% reduction can be significant to any investor based on the tax bracket they're in relative to the income they generate. So that could be a great reduction just structurally from us choosing an index option versus, let's say, an equity option. If we use the SPYI ETF, that doesn't get the same tax category. That's 100% short-term capital gains, which means it's all ordinary income. So you can have the same exposure, but not have the same tax benefits as you get with an index option.
Right.
Same thing with the synthetic option. If you have like an equity-linked note or some other type of synthetic option linked to an S&P 500, contract, that's still getting categorized as a fixed income instrument, right? It's a debt instrument. It's a structured note, or it's something issued by a large financial institution. That's 100% short-term capital gains, which means it's ordinary income. So we think using index options gives you the appropriate disclosure, correlation to the S&P. We also show those positions on a daily basis on our website. Some of those other types of products, specifically a structured note, doesn't need to tell you where they're positioned, right? You'll just know that you have exposure to a short call in the S&P. We like to be fully transparent. So we'd like the tax efficiency of the actual investment vehicle first. On the tax loss harvesting side, that's looking at our positions on a month-over-month basis with our model. And if we're able, or if the product ultimately has a loss in one of its positions, that isn't viewed always as a negative for us, right? Because we know we want to use that loss as an advantage to pair off gains in the future for investors. And so that can have a significant, difference on that tax year. right? Instead of paying ordinary income, maybe in a 40% tax bracket, right? If you're paying 0, right, that's a material increase. But the spread between paying maybe 40% tax in your ordinary income and 20% in a long-term capital gains, well, that's 20%, regardless of who the investors. I'm just choosing, right, not our product specific, just saying in general, an investor that's got an ordinary income rate of, 40%, higher side versus paying a capital gains rate at 20, that's a 20% spread. That's material.
That is.
That's a real advantage, to investors, and thinking about this net after tax return through tax loss harvesting, through index options. There's kind of a multiple of layers that allow us to help try to make as much of a net after tax income, for investors, or, really focus on their net after tax return.
Okay, so enough about tax. I can only talk about tax for so long before it drives me crazy. Let's change subjects. There's a lot of levers, as I mentioned earlier, that you're using to affect after-tax returns. So the fact that this is an active fund, I think, is really important. And you're one of the fund managers. Troy is another one. Looking at your competitors that have active management, they put their information on their websites, and I think transparency is really important. When I did the video back in June, your names weren't on the website. I had to dig into the prospectus. Your pictures weren't on there. So is that something that you're looking at changing?
We have actually already changed that. I think that's great feedback question. So we have our leadership team up on the website currently, pictures, names, bios, some of our resumes and previous firms, that I mentioned earlier in the segment. But we're also going to continue to grow and expand that. So we're constantly trying to listen to our audience, anything we hear from investors. And so we want to add the rest of our team, to the website as well. There's currently 12 to 13 of us here at the organization. So it's not a small firm, although we might be newer. The team has also worked together for well over a decade, almost 2 decades together.
Okay.
Troy and I have actually worked my entire career together. So we wanted to get that out there. I think that was a great, point that you had also brought up, but it was definitely something in the evolution of us adding more information, content about strategies, but also the firm. So check it out. I think you'll enjoy seeing the page there now, and obviously keep a note on it to watch. We'll continue to add more of the team, so everyone gets to know the family here at NEOS and who we are and what we're about.
All right. I had to laugh when you said that, because literally everything I said in that June video is now changed and become incorrect. But that's okay. It's more important to get the correct information than to be right. That covers all the major issues that I raised. If we just look now to something more fun, which is performance, looking to the future, we don't know what the S&P 500 is going to do, but I'm curious if you have an opinion on market conditions that would cause SPYI to either outperform or underperform the S&P 500, or do you think it's just going to track very close in perpetuity?
Yeah, so let's take the 3 elements. In a rising market, that's always the biggest risk to a covered call strategy in general. At some point, we're capping a portion or all of your upside. So for SPYI, in a very significant upward bull market, especially something that happens very quickly, we would underperform the S&P. You could see slight underperformance happening in the June to July period, where we saw a really big rally, 6+% in the S&P, right? We won't be able to capture all of that.
Okay.
So that's where you'd have probably your biggest negative in any cover call strategy, but where we'd see a lag to the S&P would be in a large, upward bull market, especially something that happens very quickly.
Right. Okay. And I looked at the total return, printed a copy here, and I can see what you mean. There's a little divergence there where SPYI falls behind, and I'll put this up later when I edit this, but SPYI falls a little bit behind the S&P 500, as you said, in recent months.
Yep. And then so when you start to see a flat market or something, just a slightly higher market, then we have the ability to outperform the S&P, right? Where we're going to earn both the call premium that we had sold from those short calls, and also capture a good amount of the upward side from the equity component. So you could see an outperformance in that kind of slightly higher to flat market. You'll see the same in a falling market, right? So let's just say we've generated that 1 to 1.5% income target on a monthly basis. If the S&P is down, 5%, we should be down 3.5 to maybe 4. So you'll have a loss on the equities, right? This is still an S&P, linked product, but you would have an outperformance to just being long the S&P also in those down markets from the income you've received. It's just not a buffered or a hedged product. The income, is what offsets part of the loss in the equities. So you kind of see that outperformance in a market that sells off, a flat or slightly higher, but then you'll see the underperformance in a very strong, bull market where just being long the equities would give you a bigger total return.
Right. Okay. And I asked that question not because I think as an income investor we want to time the market. That's not a good idea generally. It's more just that people keep an eye on the S&P 500 and how their fund, whatever it is doing. And when there's some divergence, they have questions. And I think the way you've explained it would answer a lot of those questions.
Yep. I know we appreciate it. We do think about this product income first, and then we want the appreciation, of course, in the total return. So I think over the last year, we've had a really good overall capture. Yes, we diverged a little bit in June into July, but then we also made that back in the August, kind of pullback or a portion thereof. So overall, good total return relative, to the income that we're also able to distribute on a monthly basis.
I looked at total returns in comparison over your first year because you've just surpassed the first year recently. Compared to your major competitors and for total return, you're outperforming them. A year is not a long period of time, but I guess so far so good. Are you happy with the performance? Is it going the way you expected?
Yes, it is absolutely going the way we expected. We're very happy with the performance. We've been very happy with the adoption from investors and the conversations we're having. So things have been going well, and we're looking forward to continuing to deliver results for current investors and hopefully start talking to new investors.
You've addressed all my concerns. So Garrett, you've been very generous with your time and you've provided a ton of clarity. So I'm going to take a fresh look at SPYI and we'll let you get back to managing the fund. I really enjoyed the conversation and appreciate once again your time. Thanks again.
Yeah, thanks for having me. It's been a pleasure and I appreciate all your support.